Uh-oh. Am I on? It didn't light up. Okay. All right. I want to welcome you to the November 10th, 2014 meeting of the Oklahoma City Post-Employment Benefits Trust. First item of business is to approve the minutes of the meeting from October 13th. All in favor? Any opposed? Next item is, and actually next two items, we've got received the monthly investment flash report for October 31st, and then presentation of the third quarter, and I'll just let Doug come and do it in whatever order he would choose.
Thank you, Mr. Chairman. Why don't we start with the short one, the October version, which appears first in your board packet. Looks like this, says October and preliminary update. If we look at performance, is this one?
Yes.
Okay.
You're good.
The first page of it is this heat map chart where we show performance of various parts of the market. When you look at the last month and the last year, you'll notice on the equity side of the table that returns for equities have come down somewhat, although October was a nice recovery. We had some very choppy moments in the market. When you look at October, there was some intense selling and then intense recovery thereafter. But looking at the last year, you'll notice fairly large dispersion of returns amongst the different parts of the market. If you start with the Russell 1000 growth, you'll see it was up 17%. The Russell 1000 value was up 16.5%. Then for the mid caps, around that range too. But when you go to the small caps, you can see that there's been a very large dispersion where their performance has been half of what large caps have been. And that's a phenomenon that happens when you have risk off. When people think that markets are risky, they tend to flock towards the larger, more stable companies. Now, when we look over on the bond side of the table, you'll see something interesting there. As has been the case for the past 6 years, T-bills are producing almost no return. 0% for the quarter, 0% for the last year, 0.1% annualized for the last 3 years, and 0.1% for the last 5 years. Of course, that's by design from the Federal Reserve to try to get people to take money out of cash and invest in equities. The long Treasury has been an interesting phenomenon to watch this year. If you look at the performance for the month of October, despite equities going up, it provided positive returns and very strong positive returns, especially compared to the aggregate. So this is the long Treasury index is a collection of 30-year Treasury bonds. That's all it is. And the BC aggregate is a composition of the investment grade part of the U.S. bond market, which is gigantic and has three primary pieces to it, which are Treasury bonds, corporate bonds, and mortgage-backed securities. So over the last year, has it been a good place to be invested? It's held value for the most part, but compared to long Treasuries at 13.2%, you can see where the real returns have been generated, and that's because this is a fear asset. When markets think that Ebola is going to spread throughout the United States, they tend to sell equities and buy Treasury bonds. When oil prices start to go down, they tend to buy Treasury bonds. And not only United States investors, but also worldwide investors, because it is the leading risk-free asset out there. So performance there has been good, and that has an obvious benefit for this trust and its current composition. So looking on the following page, the interim update, I want to call special attention to the top half of the table, which is the newly reconfigured bond portfolio. Remember, we did a lot of work on this earlier this year. July of this year, we funded 3 out of the 4 parts of the portfolio, and you can see Loomis Sales Bond is one of those. That's a corporate bond primary portfolio, so it was actually down for the 3 months, which is not unusual given their favor for corporate bonds. Corporate bond prices sometimes trade in the same direction as equities, and when there's a lot of volatility, then sometimes those prices spread out. You look at the double line bond portfolio, the next one, which performance is outperformed by a large margin. It's a very dynamic portfolio that tends to keep a lot of mortgage-backed securities in it, but has a lot of top-down investment strategies that they frankly got right this time. You look at their performance for the last quarter, 20th percentile, the last 3 months, 1.3, 18th percentile, last 1 year, 7th percentile, and last 3 years, 14%. One thing that we look at this portfolio is there's no PIMCO. I don't know if anyone has been following the saga of PIMCO so far this year, but at the very end of September, Bill Gross, founder of the firm, 41 years history at the firm, jumped ship and went to Janus very abruptly. I can say that we were surprised by it, but just for a few moments, and truly looked back at the chaos that he was causing at PIMCO and knowing that his 5 co-directors were threatening to resign if he didn't leave. Gives a lot of the story there. But thankfully, we're not experiencing that story here, and I can say that reading the financial and institutional investment press, I think you're one of the few who doesn't have any exposure to PIMCO. Loomis Sales High Income, you can see this is a high-yield bond fund. It invests in what were termed junk bonds at an earlier date. Your performance over the recent period, Loomis Sales is an aggressive manager. So in recent periods, they don't look so great, but if you look at all periods longer than 1 year, fantastic, first percentile. You will notice one very unusual thing about them. There's no money in this fund. So for the recent quarter, we're pleased with that. We're having issues with, thank goodness for their small favors. Bank of New York, we've been having an issue with them. We're a little bit frustrated with their, I guess you would say, attention to detail on this. They have said that the fund is closed to new assets. We've talked to Loomis Sales, which we have a great working relationship with. They've told us differently, and it's just difficult to get any kind of response from Bank of New York on this right now. So we're frustrated. We've been working with Bob. We've been working with staff to resolve the issue. What we're saying is that they are unwilling to or unable to fund this by the next meeting, that we will bring alternatives that they will fund. Definitely. We think the problem is Bank of New York. Responsiveness, not Loomis Sales, and definitely not Bob and his staffs getting this funded. So frustrated, yes. When we look at the returns there, it's not the worst possible thing that could have happened, but again, we expect a little bit more from Bank of New York than they're showing us on this issue. The Hoisington portfolio, remember I spoke extensively about about long-term Treasury bonds. That's their stock in trade. To use a bad metaphor. Hoisington is a unique investment manager that their entire portfolio is structured on their economic forecast, and the economic forecast's bearing on inflation and its bearing on interest rates. The portfolio can have really very few configurations. The one it's in right now is all 30-year treasuries and all 30-year strips, meaning they do not expect interest rates to rise in any stretch or any time in the foreseeable future. They have held this view since interest rates started to come down, and I'm not saying this year, I'm saying 25 years ago, with very minor changes to it. If they think interest rates will be going higher, they will reduce the portfolio's duration or their maturity to 91-day T-bills. If they think that not only interest rates are going higher, that inflation is ticking up, they will allocate part of the portfolio to TIPS, or Treasury Inflation Protected Securities, in order to preserve the value of the portfolio. Now, you're looking at them over the last year. Calendar year to date, they're up more than 25% as we started the year with interest rates around 4%, and we actually are down to 3.04% on the 30-year Treasury bond after it's moved higher in recent days. So we've seen Hoisington be a lone voice, as they were earlier this year. Last year, they had a very difficult period. They were down 16% on the year as interest rates did move lower. But so far this year, they've been fantastic. What they do is several things for the portfolio. They balance out the duration risk of the fixed income portfolio. So if interest rates are moving higher, the rest of your fixed income portfolio will suffer negative performance because as interest rates move, bond prices go down. If Hoisington gets the call right and they reduce the duration of their part of the portfolio, they will hedge that risk away from the rest of the fixed income portfolio. So they hedge part of the fixed income allocation. Something else that they're very useful for is that they hedge equity risk. When we look at correlations among asset classes, when equities go down and when volatility of the equity market spikes, which usually means they're going down, this portfolio acts as a total counterbalance to that. The correlation to the equity markets during periods of high volatility is very close to -1. And I know this sounds like some sort of hedge fund type strategy, and I can say, in fact, it is, except for the sophistication is in its simplicity, and that the fees on this are nowhere near what hedge fund fees are, which we have a major problem with. So not only does the portfolio have good capital appreciation, but also it has a yield higher than all of your other fixed income portfolios, except for the unfunded exposure to Loomis sales. Now, looking at the equity portfolio, this is the one that has been recently renovated as well, just not as recently as the fixed income. The newest hire here is Causeway, which you see having a difficult period as many international equity managers are having. I'm going to be having meetings with Causeway here in Oklahoma City next week with portfolio managers, founders of the firm, to get a real idea of what they're thinking. But remember, their process is value-oriented. Sometimes value-oriented stocks are a little bit more risky on a balance sheet basis, which makes difficult times like Europe is having right now. It hurts their portfolio a bit more. So going, yes? Now, they can vary. So in the past, they've been overweighted banks versus the benchmark, but it's really difficult to find anybody who's like that now. The portfolio is risk-averse, which we like. We've been through Causeway since almost the inception of the firm because we knew them at their previous employment. We think that they got the call on the recession ending in Europe the first time better than anybody. We think that they anticipated the non-collapse of the euro better than anyone, and that their individual company selection is great. But when we have the risk off, like we had in recent months, it really pushes everything down. The good and the bad go down. So going through the individual portfolios, just one by one, Dreyfus Appreciation, this is the biggest individual portfolio. It's probably also the most risk-averse and most conservative. You'll see that its performance versus the benchmark does look to be a little bit on the slow side. We're accepting of this. We know Dreyfus, we know Fayez Seraphim, which is the underlying portfolio manager. They invest in blue-chip, durable companies that pay dividends and grow their brands over time. And performance right now, you'll see the last year there were two periods, one where only the most aggressive companies were performing well, and then a second period where the poorest performing companies were performing well. So we like Dreyfus Appreciation as a keystone of the portfolio. We continue to. Its three largest holdings are Apple, ExxonMobil, and Philip Morris. And I will say in a year's time, it's highly likely that those three will still be their three largest performers. If you look at their 10 largest holdings, 7 of them were in the portfolio 15 years ago. So they're very long-term investors. They're very focused on buying large, stable companies, and that's why we like them for this assignment. Their downside protection is usually better than we saw in September. But they do have a rather significant overweight to energy as part of their process that was hurt when oil prices started to slide. Looking at Delafield, this is again is a fund that can look poor in the short term, but over the long term when the investment process really plays out, when you're patient with them, they can look extraordinarily good. Over the last 10 years, 35th percentile, over the last 5 years, 5th. You can see a slew of 90s. In recent periods, that's because they're investing in turnaround stories. Turnaround stories tend to be shoved outside of the market when difficult circumstances arise, and this is definitely the case. The nice thing about during 2013 is that they raised cash in the portfolio, and they're starting to deploy it to companies that share prices have gone down pretty precipitously. So they're staying with a lot of their names in their portfolio. They're taking advantage of the volatility and buying more shares and lowering their average cost. Stevens is the performer you can see the last 1 year, very difficult, but that's because they took some risk off the portfolio about a year ago as well. Recent, the last month and the last 3 months, you can see they're starting to recover from that. This is a small cap growth equity firm that oddly enough is very cautious on how they invest. They use not only bottom-up security selection, but they also try to understand why the markets trade the way they do sometimes. And it's called behavioral finance, and sometimes the market can be illogical for longer than their model predicts. And that's why they have overrides, which means that they took part of the portfolio off of the market last year. So all in all, our fixed income portfolio, you can see the managers, the ranks are quite good for the periods that we've had them, with the exception of Loomis Sales Bond. But looking out longer term, excellent results there. The equity portfolio, in our mind, is still cautiously allocated, very diversified. I'd be hard-pressed to find 3 managers of active portfolios in the domestic equity side that are more diversified from one another, given the composition of their holdings and the behavior of their portfolios over long periods of time. Happy to take any questions. Yes, sir.
Given the return figures on Hoisington under the fixed income, is their allocation underfunded?
No, their allocation was supposed to be 3%. Hoisington, in all practicality, is something you sort of have to get used to over time. Last year, they were down 17%, which in a bond portfolio, if you have 15% of your portfolio allocated to it, a very tough pill to swallow. We started them off at 3%. That doesn't mean that they will be 3% forever. Again, thinking in the entire cycle of interest rates, when interest rates are at 4%, they're trading at extremely low levels to history, it's tough to add a lot of money to PIMCO. In retrospect, we should have. But again, measured allocation at the beginning, it can be expanded over time.
Are there any other questions?
I'm specifically looking at Dreyfus, the performance over the long term for Dreyfus, and even over the 15-year period. And I know you said that, and I guess they don't track the market, but over a 15-year period, they have trailed the benchmarks. Do we know why, and why we think they're still a good?
Yes, absolutely. That is a difficult comparison for them. When you look at their rank, they're ranked versus what's called large cap blend, which means that there's growth and value, which I'm not certain that's inaccurate. But when we look at the S&P 500 and the Russell 1000, the main reason that the Dreyfus appreciation has trailed is because they own the largest companies that are out there. And the largest companies that are out there have not performed as well. If you go back to the previous page of the last 5 years, you've seen some real growth amongst the largest, 17.4, but mid-caps and small caps have done extraordinarily well. And their portfolio does not invest in immature companies. I mean, that's what we have Delafield and Stevens for. So the performance comparison versus the S&P 500, I mean, it's difficult. It's not always the proper benchmark. We don't know that there is a benchmark. The design of this portfolio is to invest in extremely large, stable, diversified companies that can pay a good yield to support the portfolio during difficult times, but then also be really keystone or a foundation of the rest of the equity portfolio.
Okay, and that was going to be my question, is whether or not those benchmarks were actually accurate, whether they were the best benchmarks to be comparing that fund to.
It's really difficult. I mean, there's one called the Russell Top 200, which is the 200 largest companies. But if you were to compare the capitalization of that versus this, the Dreyfus Fund, it would still be much larger. And over some periods of time, what we're looking at right now, the last 10 years and the last 15 years, is really, there are a few precedents, but not many, where you see small caps outperforming over that contiguous period of time. I can think back to the 1990s, especially the mid-1990s, when the markets were led by large caps. I mean, it was the biggest companies provided most of the performance. That was the era of GE, and they couldn't put a foot wrong. But now what you're seeing is that these large companies also tend to have a lot of foreign business exposure as well. And with the weakness in the rest of the world's economies, that really has hurt them on a relative basis. We continue to think that if you're going to have a portfolio and diversify, you're not always going to look good on all of the measures. And in fact, if you do, you're not as diversified as you probably should be. But we like the exposure to the conservative, large companies that should tend to do very, very well looking forward. Rising dollar, which we're seeing right now, does put the brakes on them somewhat, but over a long period of time, this portfolio is a good base that you can sort of bolt on the other allocations to.
Any other questions? All right. You want to go ahead and go into the quarterly?
Yes. So the quarterly is just behind that. The difference between this report is that we show portfolio characteristics, which will explain some of the things I've spoken about. The market environment is on pages 1, 2, 3, and 4, and this tells us how performance was in the third quarter of this year. Looking at U.S. GDP growth, positive, a slowdown from the second quarter, and we don't really know what to expect out of the fourth quarter this year with some of the impediments that are popping up right now. If you look on page 2, this is important. It explains a lot on how the market performed. On the right-hand side is a tic-tac-toe board where we show the current price of various parts of the market versus their long-term or 15-year average. So if this is above 100%, it means that the prices of these parts of the market are above their long-term average. So if you look at value stocks, large, mid, and small cap, you can see that they're actually trading above their 15-year average. Not entirely surprising given the markets are near their all-time highs. You look at the blend, you can see large caps under their long-term average on the blend, but then mid caps and small caps are over as well. And then you look at growth companies, well below their long-term average. So if you had to think, is there a identifiable anomaly in the market that we can invest in, aka someplace where we can buy cheap companies, it would be on the growth side of the portfolio. That's one of the reasons that we do like Dreyfus, because they do invest in growth companies, and that's why we think that Stevens should do well. But you see that 86%, that's the reason that part of the market, it just has not kept up with the others. And that's why we think that there's a bit of a tailwind there. Because we always think that if you're going to buy two things that you can't tell the difference between, buy the cheap one. And you should be better off in the long term. The Russell 1000 sector analysis below that shows you the individual sectors of the market. It shows the ending weight, or how much they compose of that index. And then we show the third quarter return. And again, really diverse performance here. You go to energy, which is 9% of the portfolio. It was down 8.5% during the quarter. I think we all know what that story's about, being where we are. If we go to industrials, that's another part of the portfolio that's pretty important. 11%, down 2.1% during the quarter. Financials, important, 17%, but it was up only 1.5%. If you go down to materials, again, important in some of these portfolios, down 0.8% on the quarter. So it's not often, or in recent memory, we haven't seen this much fluctuation between one sector and the next on the same period. They tend to have been either all up or all down in quarterly bases, and so this is unusual. We think it's also good for stock selectors. Now, page 3 is depicts what is a very difficult quarter for bond managers. You can see that TIPS were down, BAA or B single A corporates were down 1.9%. That's high yield. That's Lumisales, a portfolio that wasn't funded when we wanted it to be. You get the aggregate up 0.2%, and they go all the way to the right-hand side on the chart, and you see 30-year treasurers at 3.3%. So we do have allocation there. Just looking at the level of interest rates, yields and spreads on the right-hand side on the lower table there, you'll see that the 3-month T-bill, 0.2%, 2-year treasury, 46 basis points as of mid-year, rising up to 57 basis points at 9/30. You'll see that The middle part of the curve, the two-year bonds, the 5-year bonds, actually lost money, whereas the longer duration bonds, the 10s and the 30s, actually made money as their yields went down. So again, very interesting performance in the market where you saw the intermediate part of the curve actually move higher, their prices go down, but long-term bonds, great performance. Alternatives on page 4, we don't have a lot to say about that because we don't have alternative investments here. But then looking on page 5, performance, choppy quarter, strong year, 3 years, 5 years, and 10 years. Performance has been absolutely phenomenal. We have participated in that. Total fund rate of return on page 6 is 6.2%. We'll power through this and go to, say, page 10, which is the page numbers are on the left-hand side. Loomis Sales Bond on the left-hand side. What this chart tells you is for the total fund how performance was. And it was a loss on the quarter, and given that we have a balance between equities and fixed income, not a surprise. You'll see the loss of 2.5%. You can see where these individual pieces added up to get that. So Loomis Sales Bond, which is the one that was funded, was down on the quarter. Double Line was up slightly. Loomis Sales High Income had no impact. And then you'll see Hoisington at 0.1%. You'll see Dreyfus Appreciation down. Delafield was the one that hurt the worst, given the fact that they're buying relatively troubled companies and turnarounds that did not perform well. Stevens Small Cap at negative 0.5, and then Causeway at negative 0.3. As we go through the following pages, why don't we go just get a better idea of the composition of some of these portfolios on page 13. Loomis Sales Core Bond, and remember we replaced J.P. Morgan bond with this new suite of managers, and we think it was a great time to do it because J.P. Morgan's performance has struggled versus these as well. For the quarter, which it's shaded because it was not the complete period, difficult time, down 1.8%. You look at their composition on the credit quality, 37% in U.S. governments or AAAs. As we go down the list, you see that they have quite a significant allocation to triple Bs, double Bs, Bs, and below B rated, because that's really where they're skilled, is buying corporate bonds. Their duration was actually shorter than the market, which in this case hurt as that part of the market showed some fluctuations that were unusual. A nice diversifier to that is Double Line Core on the following page. This is a newer firm. It was a spin out of a fellow who was at TCW, left abruptly, started his own firm. That's why we don't have 5-year returns, because it is relatively new, but it was a firm that's gathered more assets faster than any other institutional manager in history. Their allocation to U.S. governments is 15%, AAAs at 43%, so they're allocated less in the higher quality government names, but they have a lot in the triple Bs and the double Bs. Again, a lot of their strength is in the mortgage-backed securities market. It's very complicated, and it's a place that holds a lot of opportunity for managers. Loomis Sales High Income, again, small favors. We weren't invested in them during the quarter, a loss of 2.5%. But going back over the last 1, 3, and 5 years, the returns have been good. And then Hoisington, over the last 12 months here, you can see their results, calendar year to date through a few days ago, they're up 25%. But again, that volatility or that magnitude of returns can go the other way. 100% of the portfolio in U.S. governments. Total holdings, 17. The trailing 12-month yield is 2.6%, and the duration is 20. The dollar-weighted maturity of these bonds is 20 years. So the others are 4s and 5s. This is 20. Definitely unusual. We've spoken about Dreyfus Appreciation. 3 largest holdings, Apple, Exxon, Philip Morris. The performance here, energy at 17.4% versus 5.7%. So that's unusual. A lot of consumer names as well. More on the defensive side than the cyclical side. And technology at 14.6 has been one of the reasons they've underperformed. 10 years ago, they wouldn't invest in anything that was technology-oriented. But now you'll see the largest holding is Apple, because it fulfills what they're looking for. A solid brand with an identifiable product with loyal customers and worldwide reach. Delafield, again, they look really, really difficult right here. But again, this is a smaller portfolio that over short periods of time adds value. And in difficult times of performance like this, you can see that in the past they've really compressed a lot of value in the portfolio, that once the market starts to head their way, that value expands almost like a spring performance-wise. And then Stephen showing some, on page 16, showing some improvement over the last 12 months versus the quarter. And again, the average weighted market cap on this portfolio is slightly larger than the Russell 2000 growth, but if we could... And then Causeway, a new manager as well, founded in March of 2014, 5th percentile, doing better than its benchmark during the real quarter that we've had them, and then you can see longer-term results, top decile or near top quartile. So as we go to performance, on page 18, performance has consistently been above actuarial assumption. That's our the first benchmark we look to. We want to outperform the actuarial assumption. We want to protect on the downside. And there are several parts of the portfolio designed to do especially that. $29 million in the fund, so it's showing very nice growth, mostly from contributions right now, although this portfolio is adding some value over the last 3 years, 11%. And the following pages I like to focus on, I've run long here, but I want to focus on page 24, page 25, and 26. Manager status summary on page 24. We do not recommend any change to Dreyfus appreciation. Given the performance of Delafield, we would like to recommend they be placed on alert. The others we have no recommendation on. Page 25 is, there's a lot of information on this page. This is a performance correlation matrix which shows you how the performance on a monthly basis performs versus one another. And when you look at the bottom row, which is Hoisington, which is supposed to be our hedge to difficult months in the marketplace, and see that they have negative correlation with all of the equity managers, but then they also have a negative correlation with 2 of your fixed income managers. So that's extraordinarily useful on being able to stabilize the portfolio's value. And then on the following page, page 26, is the expense comparison, which we want to make sure that we're getting what we pay for here. We do a weighted average of the individual funds versus their category average, so this would be the average mutual fund in each of these categories. 0.89 is the expense ratio on a weighted average. The category average is 1.14, so on a difference basis, you're 26 basis points better than the average in the category, and we like that. So in the markets, it was a difficult performance. It was difficult for some of our active equity managers. The fixed income portfolio, we're happy to see that it's performing well, and it's in much better shape than it was when we started on that project. The new international equity manager is performing well. But again, these things do take time. As investors, sometimes the hardest reflex, or the hardest reflex to repress is the one to get rid of good managers when they're having periods of underperformance. I know that some of these firms don't look like their peers, and that's one of the reasons that we're drawn to a lot of them. But overall, when thinking portfolio structure, this is, it's a strong structure, it's sophisticated, it's multi-layered, and there are many levels to each of these managers individually and how they fit together.
If you look back on page 10 on the graph there, the bar chart,
Yes.
so it doesn't look like the numbers on the performance match up with the numbers on the report if you go back to page 18.
Sure.
I was trying to figure out how no one is below 1%, and then we end up at 2.5% down for the portfolio as a whole, but it looks like some of the numbers didn't go through correctly.
So what this does is it shows you, you take the weight of the individual pieces and you
it's the
multiply
weight
it.
because
Yeah,
of the
so
weight,
this is new and it's sometimes hard to communicate, but yeah, this tells you relative to one another, what helped
Okay.
the most, what hurt the most for the quarter. So it's a weighted average contribution. to
Okay,
the
so it's
total
not
return.
giving you the straight, okay, I got it.
Although that might be interesting. I bet we could just figure out a way to show both on the same page.
Yeah,
That'd be interesting.
okay. And then you said you're going to put Delafield on watch,
On alert, yes.
on alert, okay. Okay, are there any other questions?
Well, I do have a question. Looking at 24, which I think is what Craig was just talking about. So Dreyfus Appreciation's been on alert since the fourth quarter of 2013. So I think this is a little bit of what Diana was asking about earlier. I mean, how much longer will we wait before we change that?
Well, again, the comparisons are difficult, right? You're showing them versus benchmarks that aren't very similar to their portfolio. You're showing them versus a pure universe that is not truly representative of what they do. I mean, we tend to find managers who are unique. And this is a conversation that we have with many of our clients. It doesn't look good versus the comparisons that we're showing. Comparisons aren't 100% accurate, but the fund is doing what we want it to do. And in our eyes, sometimes we place managers on alert just to remind ourselves what's going on. Okay, how do we feel about Dreyfus? Well, the performance is not as good as we want it to be. They're there for a very unique reason. You know, we're pretty risk averse in most of this portfolio. And given that that's the largest equity piece, we want it to be pretty stable. When the market's down 20%, we don't want to track the market at that time. If the market's up 20% and they're up 10 or 15, that's satisfactory in our eyes. Now, if that's not useful here, if that's not the track we need to be following, then we can definitely make changes. But what we sought to do when we redesigned the equity portfolio, let's have one piece that's the foundation, very low risk, very solid, very strong portfolio companies, and then we're going to put Delafield and we're going to put a small cap growth, the Stevens Fund, alongside it and let some of those add value. And over the long term, what we would expect is to take profits from the other two most of the time and put them into the fixed income to pay benefits, or to put them back into the appreciation fund to sort of compound at a lower rate over time. It's a risk regulation design.
And I don't disagree with that. I think that the on alert status is useless. If what we're saying is, well, they're unique and they don't compare very well to the benchmarks we've chosen, then what does on alert really mean?
It's a recognition that we're still kind of getting to understand how their performance goes. I mean, we're satisfied with them. We don't see making a change to Dreyfus Appreciation based on just their performance, because this is one that takes some patience at times, but it's the keystone of your portfolio. I mean, if it is in any way misleading to you to have them on alert, given that hopefully we've explained their rationale in the portfolio, then we should take them off of the alert status.
I don't know that I necessarily agree with taking them off alert. I think that the bigger issue is the comparison to the benchmarks. I think that that's what's misleading. So if we were to have to explain this to someone, it's very difficult when we use benchmarks to see how funds are performing. And if these are not the appropriate benchmarks, then maybe we need to look at something that's more appropriate, a more appropriate comparison.
Or at the very least, if we had some metric that we can use that helps assure us that it's performing as it should and it's giving us what we need. I mean, if we have some other way that we can point to it, and that's, again, I agree with Diana, it's our simple, for us, we're looking at benchmarks and we're looking at comparison to the rest of the market, and so it makes it more challenging for us to really assess that value, and you're sounding very confident in them, but if we just look at the numbers, it would be really hard to defend for us.
So why don't I come back to the next meeting with updated benchmarks and our rationale behind those.
That would be
Because-
great.
And I understand the position you're put in. When you show just the numbers, it's not a great story.
Well,
But-
and it would be one thing if it was just the numbers, but it's the words, too. The words say on alert
Gotcha.
since
Yes.
fourth quarter.
Yes.
And I agree with Laura that I think if we are going to come up with if we're going to look at it a little bit differently, we have our justification, that really we should take them off alert if we don't think they really should be in that status. If we're not concerned at all about them and we think they're performing as they should, help us to be able to communicate that and understand that ourselves. But then I agree that I think it should come off alert if we think they're performing well.
Well, I disagree. I disagree that they should come off alert until we find a more...
Yeah, I'm not
appropriate
saying right
benchmark.
now.
Yeah.
I'm not saying right now.
I think
but-
that if we find a different benchmark, and we agree that that is a more appropriate benchmark, we leave them on alert for a period of time to evaluate their performance compared to that new benchmark, and then if we see that their performance is pretty good based on the explanation, then we can take them off of alert. But I disagree with taking them off right now.
Understood. We'll come back next
Okay.
month with not only new benchmarks, but also full descriptions and rationale of why it's the appropriate benchmark.
Okay. All right, thank you, Doug.
Thank you.
Doug's going to speak to the next item, so I'll just let him stay right there. Let me go ahead and get a motion to receive the monthly investment flash report. All in favor? Any opposed? All right, the next item was back to the issue with the Loomis Sales high income and the issue with Bank of New York.
Yes, again, confusing, frustrating, very difficult as they're not getting back to anyone as quickly as they should. We've escalated it from our end as much as we can. Again, Loomis Sales, this is not a fly-by-night fund. This is a well-known fund company. Bank of New York is having a tough time getting into that allocation like we want. As a potential workaround, we may have to go to a different high-yield fund. We don't want to do that, but we may have to. Bob and I were talking before, well, this says additional asset allocation or changes to the portfolio. Before we bring any new manager into the fund, I at least want to present it to you. So what we're saying here is maybe we would put it in place beforehand, but I'm not in favor of that. I think that it's part of our job to introduce any new investments to you before it goes in. So this is a way to start moving down that road.
So does that just leave us that we have to leave it in cash until we can get something resolved, or until the next meeting where we can make a decision? We don't have any other authority to invest it anywhere else.
Our intent is to get with Bank of New York and find out whether or not that fund is closed or not. If it's not closed or some situation has changed, we'll go ahead and have them invest in the Loomis High Sales, or Loomis Sales High Income. If for some reason that fund is closed, then Doug will work on a recommendation and he'll bring back to you at the next meeting that you can then vote on.
Okay, great. So we don't need to take any action on this then. We'll just look to that to the next meeting, or be in the Loomis Sales high income.
Correct.
Okay, all right, thank you.
Thank you.
So do I need to do anything with that one? Are we okay? Okay. The next item is to adopt the resolution. It's a joint resolution with City of Oklahoma City and the MFA on the management of the ATC, with CARE ATC for the employee health clinic, and it's an employee health clinic as well as it's available for retirees who are not Medicare eligible. And so this is the approval of that agreement. It also has an agreement on here it's a resolution approving the agreement. The agreement's attached, and then there's a part of the agreement, there's a business associate agreement, basically saying that we will comply with all the HIPAA regulations on privacy and security of patient information. And I'd be glad to have any discussion with that if you'd like. One thing I do want to point out is in the memo, we just note that it's on the third page of the memo. The estimated cost is $1,332,000, and that would be a total cost of the clinic. It's not just the Opebt cost, and we just tried to clarify that the intent is we will allocate the cost between Opebt and the MFA, Opebt paying for retirees and the MFA paying for employees. But Diane and I wanted to have an opportunity to work with Colin and with CARE ATC to see if we can get a good assessment of what our participation actually is from retirees. Right now, I think if we did a split just on the population of those eligible, it'd be about a little over $200,000 cost to Opebt. But as we look at it, we think likelihood is we'll have a little bit lower participation from retirees than we would from active. So we didn't feel like that was a reasonable method for allocating the cost. So our commitment would be that we will come back to the Opebt Trust. I don't think we'll have to necessarily do a contract amendment on that because it's just how we allocate the cost, but we will make sure we bring an informational item at the least to the trust so that you know what our approach is going to be on allocating those costs.
Yeah, at this time, I just want to follow up with what Craig was saying. The $1.3 million cost currently will be absorbed by the MFA. Craig and I will meet with additional staff to determine a proper allocation method, as he said, based on utilization. We want to see what utilization is going to be. We think that that's the fair way to approach it. So for a period of time after the clinic is open, we will evaluate the utilization by the non-Medicare retirees and then return to this body with a recommendation on a reimbursement strategy.
Diane, I've heard so much about the clinic that I don't feel like I have any questions, but I just want to make sure that our trustees that are not currently employees understand the benefits provided by the clinic and the location and all of that.
The location will be in the new Arts District parking garage across the street. We anticipate an opening date early 2015. We were anticipating January of 2015 realistically because they are having to bid out the build-out of that facility. It's probably going to be more like February or March. Primary care-related services will be provided to employees and non-Medicare retirees at no cost to that group, and what that means is if they have chronic illnesses such as hypertension or diabetes, they can receive treatment at the clinic. If there are medications that are needed, there will be a limited list of generic prescription drugs that will be dispensed at the clinic. Laboratory services will be available at the clinic, and that will all be at no cost to the employee, the retiree, or their dependents. So their dependents will be allowed to utilize the clinic provided they are at least 2 years of age. There is no restriction on the number of times they can visit the clinic in a month, so it's unlimited utilization. We are hoping that by opening the clinic, we will experience a reduction in overall health insurance costs. So if utilization is what we anticipate it will be or what we think it needs to be, that will drive down the cost of the health insurance program, since those services that could normally be run through the health care program will now be received at the clinic at a significantly reduced cost. So we're very excited about it. We will start informational sessions very shortly with retiree groups and employees to get information out so that they can be just as excited as we are.
Would that include any instructional published material?
I'm sorry, Frank, I didn't know.
Publications or...
Yes, we will send out written material in addition to having on-site meetings at various locations with the different groups that will be eligible to participate in the clinic.
You answered most of my questions that I turned my mic on for, but specifically, why are Medicare eligible excluded?
We did take a look at that, and I will say that right now we have excluded Medicare retirees since Medicare is a primary insurance coverer. And under our health insurance plan, that is not the primary driving cost of the health insurance plan. Prescription drugs are the primary driver. And as you will recall, we just recently implemented a new prescription drug program for Medicare retirees that we anticipate over a period of time will save a significant sum of money. However, that does not mean that we will not at some point look at or consider including Medicare retirees as users of the clinic. But we want to see what utilization is going to be for those that have the city's health insurance plan as the primary cover.
And Ted, I guess I would ask you, do you think that there would be a good utilization by Medicare eligible? And the reason I say that is because I don't know that they're coming downtown or that they would want to come downtown for their medical care.
Well, a lot of my peers still come downtown for their medical care. I do. My wife does. And I don't think we're alone in that. So I think there might be the advantage. I haven't been on, well, I only became Medicare eligible 2 weeks ago, so I don't know about the model there. But even on Medicare, are we still not paying co-pays?
Yes.
Okay. So it seems to me we're kind of creating two classes of people, those who are Medicare eligible and will continue to pay co-pays, and those who are not Medicare eligible and can go to the clinic and not pay a copay.
Well, they're not paying a copay at the clinic, but if they utilize the health insurance plan, they're still going to pay a copay. And understanding that Medicare-eligible retirees are only paying that city copay for whatever portion, if there is a portion that Medicare doesn't cover, and the city's health insurance plan then becomes a secondary payer, then that's when that copay comes into consideration. And as I said, as we were evaluating this, we did consider the Medicare-eligible retirees, but because that was not the medical services are not the primary driver of our expenses on the health insurance plan, we opted not to include the Medicare retirees at this point. Does not mean it won't happen. It just, Medicare retirees haven't been included at this point.
Well, and it sounds like a good model, and I would certainly support it, but as you know, I'm somewhat oversensitized about the issue of the same class of people, but one having to pay more than the other without good cause. And it seems to me that if Medicare eligible are still paying co-pays when they make their doctor's visits, and were I eligible to go to the clinic and I pay no copay, because as you say, there's no fee, it seems to me that my health care costs are going to be greater than a retiree who was not Medicare eligible.
I don't think that's necessarily a correct statement. Colin, you want to address the doctor's visits for Medicare versus non-Medicare retirees?
We'll just use a rule of thumb here. Typically, when you're in Medicare is going to pick up 80% of the cost. So that savings the city would not have, because if you're on a Medicare plan, Medicare is going to receive the benefit of the city funding a clinic for services that would have been paid by Medicare. So that's why the cost derivative did not go to the city. It would have gone to Medicare. So we just decided at this time, because we didn't think there'd be some utilization or that there'd be the savings to the plans, because this is primary for active city employees, which is our biggest bulk of people, which is our biggest group of expenses, and then our under 65 retirees, because they are still similar to the active employee population. That's where our cost drivers are. So we're trying to attack some cost drivers there on that non-Medicare population. And they are a little bit different group, because Medicare is such the big behemoth on that group and their cost-sharing structure. And yes, the Medicare person's going to have to pay co-pays, and there are the Medicare premiums that everybody pays if you're on Medicare. So that is acknowledged. Now's not, we didn't think it was the right time to expand that out to the Medicare population. And the Medicare side also is prescription drugs. Half of that cost on that Medicare population is prescription drug. So we're trying to address that through the EGWIP, the Medicare Part D group plan that we instituted for 2014, and address that issue on the prescription drugs. The clinic doesn't solve the problem on prescription drugs, because the clinic's going to dispense a list of generic drugs, which is in your contract there, and then those are real common type things to treat minor things. But as you well know, people that are older tend to take on the average 5 or 6 prescriptions. And that's where your costs are. And when your prescription cost is $90 to $100 per month on the average for that population, that's a big bite. And so we're trying to get to that through the Medicare Part D plan, and the clinic doesn't address that issue. So that's maybe a little longer explanation than you wanted, but that's some of the mind think today is where we are on that.
And I think, Ted, what, just kind of summarizing on the expense side for the Medicare eligible retiree, what Colin was stating is that there is a direct cost, or what could be a direct cost savings to the city's health insurance plan by including the non-Medicare retirees versus the Medicare retirees, because the city does not benefit from any cost savings for a Medicare retiree participating in the clinic. That benefit is directly tied to the Medicare plan. So Medicare is who receives that cost savings, not the city's, not a direct savings to the city's health insurance plan. But we're still looking at it. We'll continue to evaluate that.
Thank you.
I move approval of the resolution.
All in favor?
Aye.
Any opposed? All right, thank you. Next up, we have our interim financial statements, and Mitchell Massey's here from Accounting Services to give us just an overview on the interim financial statements.
Good morning. First, I would like to direct your attention to page 3, the Management Discussion and Analysis, Changes in Net Position Reconciliation. Currently, the Trust is reporting net position of $35.09 million. This is an increase of $6.3 million over the prior year, when net position was reporting at $28.77 million. Overall, the financial position has improved during the year. For the fiscal year, the Trust gained approximately $1.03 million. Of this, $818,000 is from net assessed revenue from indemnity plan, along with excess employer contributions of $900,000 offset from an investment loss of $700,000. Next, I would like to direct your attention to page 6, Statement of Changes in Plan Net Position Reconciliation. Additions are reporting at $6.7 million versus $8.4 million in prior year. This is mostly due to investment loss for depreciation and fair value of investments. Benefits were $5.7 million, which was a decrease in $200,000. Next, I would like to direct your attention to page 10, the Asset Allocation Guidelines. In our asset allocation guidelines, fixed income securities are reporting at 24.8%, leaving the remaining to equities at 75.2%. If you look above on page 9, the money markets used to pay claims are reporting at $6.6 million compared to the prior year of $3.1 million. Are there any questions I can answer regarding these financial statements?
Is the additional amount that we have in the money market, is that due at least in part to the issue with the Loomis sales?
That's the amount. Yes, I think that's related to what hasn't been invested.
Yeah, that would be, and that's what I was talking to Doug about. We think we have some money in money market that we can invest. We'll run a cash flow again and see.
So we have some we're ready just to reinvest within our allocation.
We think so, yeah.
Plus we have the money that's there waiting on the sidelines for Loomis sales investment.
I don't know, did you say that you think that the Loomis sales is included with this?
I believe that's what it is, but I can check with that and get back with you.
Okay. Okay, that's fine. Are there any questions? All right, I'd take a motion to accept the interim financial statements. All in favor? Any opposed? Next item is to receive the schedule of regular meetings for calendar year 2015. Those are included in your packet. Are there any questions?
Do we have to keep meeting? We haven't done this, right?
Yes, we do have to keep meeting. Thank you for the question.
Okay.
All in favor? Any opposed? The next item is ratifying the claims listing. All in favor? Any opposed? Are there any other reports or comments from staff or from any of the board members? All right, hearing none, we are adjourned.